Afternoon, everybody. This is Chuck Hughes. Welcome to our first in a series of member webinars for the weekly option advisory. I plan on having these webinars on a regular basis to stay in touch with the members and to help them maximize their profits and their use of the weekly advisory service. As always, my support staff welcomes your questions and concerns. So whenever you have questions about the advisory service, feel free to email us or call us, and we'd be glad to help. And our only goal is to make you a successful trader and to help you utilize the option advisory service, weekly option advisory service, so that you do become a successful trader. And we have a number of portfolios. This is a snapshot of the member section of the weekly option advisory, and you can see we have several portfolios. We have an option portfolio. We have a small account option portfolio, and we have a what we call the super portfolio. And then we have a super stock portfolio, a covered call portfolio, small account covered call portfolio, and then we have an option spread portfolio. So we have a total of 7 different portfolios, and they're going to be initiating what they call mini options here in the near future. And mini options cover 10 shares of stock instead of 100 shares. So if you were to initiate a covered call trade today, let's say that covered call trade covered 100 shares of a $50 stock and it cost $5,000. Well, with these mini options, you could just buy 10 shares of the stock and sell a call option, and the cost of that trade would only be $500. So that's going to bring down the amount of capital you need to trade all of these various portfolios that we're going to discuss today. So just keep that in mind. We have the 7 portfolios, and we also, on the member site, we list the closed trade results. You just click this link here, and you'll get all the closed trade results. And we also have a link for strategy videos, which we'll talk about in a minute. So each one of these portfolio links, of course, takes you to the current open trade results for each portfolio. And while a trade is open, we show the open trade profits and percent gain for each position, and that's updated real time every day so that you can get an updated performance on each portfolio on a daily basis to see how the portfolio is performing. And we send out a email for all trade recommendations, whether we're initiating a new trade recommendation or rolling over a current position or closing out a current position. So you'll receive an email with instructions on what to do with each trade and each trade recommendation. And for each of those 7 portfolios, when you click that link to the portfolio, you get a trade recommendation table, and then you also get open trade profit table. And this is a snapshot. This is the small account covered call trade recommendations. So there's a table for the covered call recommendations, and we list the date that we opened the trade. In this case, this is a covered call, so we're buying the small cap ETF, symbol TNA, and we're selling the TNA December 14th, 58.5 weekly call. So and we list the symbol for the stock on the top line and then the symbol for the option on the second line. So this is a covered call trade initiated on this date, and of course we buy the, in this case we're buying an ETF and selling a call option against the ETF, and that creates a covered call trade. Now in the trade recommendation table, you'll see there's a column here. It's buy, sell, or hold. And if you see a trade that's on a buy recommendation, then you can take that trade at any time as long as it says buy here. And sometimes those trades will be changed to hold, and other times when we close out a trade, this will say sell right here. So so you always know what you're supposed to be doing at any given time by just looking at this column, the buy, sell, or hold column. And right now this is still a buy, this trade. We'll be rolling this trade over tomorrow, and this is a weekly covered call on the small cap ETF. So you can see that it says buy here, so this trade is still on a buy. So any trades that are labeled as a buy, you can take those trades even after the original recommendation was made. And in this case, we have this may be a little bit confusing because we have buy here and we have sell here, but that's because it's a covered call trade, and what we're looking for with covered call trades is a buy, and this first line here, as far as the if we want to know what the status of the trade is, we look at this first line for a covered call trade. For an option purchase, of course, it would just say buy, or a super stock recommendation, there's just one line and it would say buy, sell, or hold. So look at this column if you want to see the current status of a trade. And then, as I mentioned, every day in real time, each of the 7 portfolios is updated, and we update the current price of the stock or ETF and the option. So in this case, this is the open trade table for the super portfolio, and each day all of these trades are updated based on current prices. So you always know the current profit loss for each trade and each portfolio on a daily basis. And when we close out a trade, the trade will move from the open trade table to the closed trade table, and these closed trades are based on monthly results. So when I took this snapshot, we took this is a snapshot of the March closed out trades, and it'll list the strategy, the stock or option, the symbol, the number of shares that we bought, the day we entered the trade, the entry price, the exit price, and exit date, exit price, and then the profit or loss, and then the cumulative profit and the percent return. So each trade is either an open trade or it's a closed trade, and when we close out a trade, it moves from the open trade table to the closed trade table so that all trades are accounted for. And we also, in the member section, at the bottom here, we have a strategy videos link, and here's an example of, if you click that link, this is what you're going to see. And you're going to see these various videos, and these are helpful for members because in these videos we explore the basics of the various strategies, and I also offer insights into the current market conditions and also which strategies are working best for the current market conditions. So this is a great source for members if they want to get an overall view or explanation of a strategy. We include include that in the videos along with current market conditions and which strategies are working best. And so that's a good source for all members to view these strategy videos. And we have a new one every 2 weeks. So let's talk about the various portfolios and the amount of risk associated with each portfolio. And then we're going to take a look at the various strategies, and then I'm going to show you some recommended allocation based on account size for the various portfolios. So let's just start out with the relative risk of these strategies, and this list is from lowest to highest. So the lowest risk strategy would be the covered calls, and with a covered call, we buy a stock or we buy an ETF, and then we sell a call option. And when you sell that call option, cash is credited to your brokerage account. So that reduces the cost basis of the stock purchase and gives you some downside protection. So this is the lowest risk of our various strategies. Next would be the super stock portfolio, and we'll discuss that. Next would be option spreads, and with option spreads, we purchase an option and then we sell an option, and it's similar to the covered call strategy, but instead of buying a stock, we buy an option. So the cost is lower and you have more leverage, so that's a little higher risk than the covered calls, but you do get downside protection with these option spreads. So if you buy a call option and then sell a call option, you create a covered call because the trade is covered by the option that you purchase. And we'll take a look at that strategy also. Then we have what I call the super portfolio, and in the super portfolio we purchase super portfolio stocks that are performing well in the current market environment, and then we'll sell an ETF option against that stock position in a weaker performing ETF. And then the highest risk strategy would be the option purchase, because the option purchase options are leveraged, so whenever you have leverage involved, you have higher risk. And I wanted to talk first in general about the market conditions over the last several years. I've been trading for 28 years, and I don't know if any of you ever traded in the 1980s or 1990s, but the markets tended to trend a lot better than they have over the last several years. So I don't know if this is the new normal, but the last 3 years or so, we've had a lot of price volatility and very little trend. Here's a snapshot from 2012. This was earlier in the year, and you can see we have a lot of price volatility here, but the S&P index is just about unchanged. So this is pretty typical of the way the markets have traded the last several years. So we are using strategies that will work even in this type of market environment, where you have a lot of price volatility and very little trend. And I'll show you a couple more snapshots here of the S&P just to give you an idea of what it's been like the last several years. This is a snapshot of the S&P in 2011, and we had 68 days in 2011 during which the S&P closed up or down more than 2% in one day. So a 2% move in the S&P in one day is a huge move, and to have 68 of these days, which was about 25% of the total trading days, to have that kind of volatility it's just a lot of volatility. And whenever the index closes up or down more than 2%, that's a big move. But to have 68 of those, that's a lot of volatility over the course of a 1-year period. So here's the daily price chart of the S&P in 2011. These vertical lines, and you can see a lot of price volatility, but virtually no change in the price of the S&P. So the challenge becomes, if you take a directional stock or option trade and use a money management system, you could easily get stopped out with this kind of price movement. So the challenge becomes to take a trade that's a lower risk trade, and you have a higher probability of not getting stopped out in this kind of a market. That's what we do with our directional trades, and then we also trade spread trades. And the spread trades, of course, they can profit if the stock goes up or down, depending on the strike prices of the spread trade. So we'll take a look at those. And so it's been very challenging the last 3 years. Here's a snapshot of the S&P 2010, and again, you see that a lot of this price volatility. But over this time period, the S&P was virtually unchanged. So it's been a real challenge these last 3 years. This may be the new norm, and we may just have to adapt our trading strategies to profit in this new norm. It may go back to more of a trend market like we had in the 1980s, 1990s, and then again in 2003 through 2008. Here's another snapshot, 2011. Again, you see a lot of price volatility, but the S&P was virtually unchanged. And here's an interesting phenomenon. This is a price chart of 2011, and the S&P actually opened the year at 1257 and closed the year at 1257. So it was literally unchanged for the year, even though we had all this daily price volatility. The index opened at 1257, closed at 1257. So that's a real challenge, whether you're taking trades from the long side or short side in this type of market. Here's a snapshot from July of 2012, and again, we see a lot of price volatility over the previous 12 months, but the index was virtually unchanged over this 12-month period from July of 2012 to July 2011. So again, a lot of price volatility with the index being virtually unchanged. Here's a more recent 3-month period of the S&P. Again, a lot of price volatility, little change in the index. So this could be the new norm for going forward as far as the general market conditions. So we have to adapt to that, and we have adapted to that, and it's a challenge to profit with directional trades in this type of market. The spread trades perform better in this type of market. So let's talk about, for the first strategy we'll talk about is trading weekly covered calls. And the way, if you're not familiar with covered calls, the way the trade is initiated is you buy 100 shares of a stock or an ETF, and then you sell a weekly call option. And as I mentioned earlier, this is a relatively low-risk strategy. You can do these in most retirement accounts, and it's the lowest risk strategy that we have in the weekly option advisory. And when you sell an option premium, cash is immediately credited to your brokerage account. So if you sell an option premium, let's say for 4 points, then $400 in cash is immediately credited to your brokerage account. And we can collect this cash income every week with weekly options. So every Friday, we have an opportunity to sell another premium, and that can really add up over time. And if you roll your covered call trades over weekly, then you can really compound your returns very quickly. And I'll show you some examples of that. So the basic concept behind selling option premium, if you sell an option with 4 points of premium, $400 of cash is credited to your brokerage account. And this cash credit, it reduces the cost basis of the stock and reduces the overall risk of your trade. So selling these weekly option premiums allows you to compound your returns very quickly. And I'm going to show you an example of how selling this weekly option premium can lead to a 100% cash-on-cash return regardless of the price movement of the underlying stock. So, for example, if you invest $4,000 in a covered call, on the cost of a covered call, over the period of a year, you could collect $4,000 in cash income. So you can collect up to $4,000 on a $4,000 investment. So that's a cash-on-cash return. So these weekly covered calls, they've been profitable in every type of market condition. And I'm going to show you my real-time results over the past 3 years, and with these covered calls. And even though we've had these very difficult markets over the last 3 years, I've made over $1.1 million trading these covered calls. And as we mentioned, because you receive that cash premium every week, there's less risk trading these weekly covered calls than there is in simply owning the stock or the ETF. So weekly options, they start trading on Thursday and they expire the following Friday. So they have a life of 6 trading days. So they start trading on Thursday, expire the following Friday. So and you get 52 opportunities each year to sell option premium with these weekly covered calls. So this allows you to roll over your profits each week and then compound your returns, because when your profits start compounding, that allows you to buy more shares of stock and sell more calls, covered calls, and then you can start compounding your returns. And as I mentioned, over the past 3 years, the covered call trades have generated over $1.1 million in actual profits, and these profits are listed in the weekly option manual on page 176. So, and keep in mind these last 3 years, as I was showing you those price charts of the S&P, this is a very volatile period with very little trend. So these covered calls have been working well in this type of market condition. And also, with the covered call trades, I've been doing these for many years, even way before they started trading the weekly options. And over the past 5 years, selling this option premium, I grossed over $7 million selling option premium. Now that's not net profits, but that's I sold $7,485,000 in option premium, and that was cash that was credited to my brokerage account. The net profit was less than that, but it was over $7.4 million in gross option premium. And I have all these trades listed in my U.S. Money Strategies book. So this averages out to more than $124,000 in cash income per month. So I've been real active with the covered call strategy over the past 5 years. And in 2009, I won the international trading competition, and I was trading covered calls in that account. And at that point, they were not trading weekly options, so these were monthly covered calls. But I was able to roll over those monthly covered calls and start compounding my returns. So that year, in that trading competition, I started with $100,000 and I had a $122,000 profit. So I had a 122% return that year, and this was in 2009. And this is a real money contest, and all the results are audited before they're published on the sponsor's website. So this covered call strategy, by rolling over and compounding my returns, even though there were monthly covered calls, I was still able to generate 122% return that year. And this year I've made as much as $68,000 in profits over a 1-month period trading these weekly covered calls. So let's just go over the basics of selling option premium. The basics, options consist of time value and intrinsic value. So at the money and out of the money calls consist of only time value. So if you're selling an at the money call or an out of the money call, that's 100% time value. There's no intrinsic value in these at the money or out of the money calls. So at option expiration, options lose all time value. So if you're short an option, the time value portion of that option becomes profit at option expiration, regardless of the price movement of the underlying stock. So just keep that in mind. That's the basics behind selling option premium. At expiration, they lose all time value. So if you're short that option and it loses all time value, that becomes all profit at option expiration. And here's a recent example. This is for the small cap ETF. And I own this ETF, and I roll over the options, the weekly options every week. And this is just I took a snapshot a couple weeks ago, and this is a option spread order, an actual option spread order that I use to roll over my weekly covered calls. So what I like to do is I like to hold this ETF in my account, and then each Friday roll over. I close out the expiring option and then roll over to the new option. And I simply hold the ETF in my account. And to do that rollover, I use an option spread order, and this is an actual order that I used. And I closed out the November 23rd weekly calls, and then I sold to open the November 30th. So I was closing out November 23rd weekly calls and opening up the November 30th. Now I have since rolled those over to the December 7th weekly call and the December 14th, and then tomorrow I'll roll over from the December 14th to the December 22nd. So this is an actual rollover order that I used, and you can see at the time the small cap ETF was trading at 54.27. That's this price right here. So ETF is trading at 54.27. So I was selling the November 30th 54.5 call. So the strike price was above the price of the ETF, which was trading at 54.27. So this was the at-the-money call, and that premium was selling for 140 bid and 145 ask. So what I like to do with these spread orders is split the difference between the bid and the ask. And so again, this premium here is an at the money, and it consists of only time value. So let's look at my actual fill. So I was able to sell short the 54.5 call at 142. So that kind of split the difference between the bid and the ask. So I sold 8 of the 54.5 calls and at 142. So at 142, that's $142 in time premium per option. So I collected, after commissions, I collected $1,125, and that's cash that went into my brokerage account on the day that I sold these calls. So again, with TNA trading at 54.27, this 54.5 strike was at the money call consisting of only time value. So again, that time value becomes profit when you're short an option. That becomes profit at option expiration. So this $1,125 becomes all profit at option expiration. So let's say that you were going to initiate a new covered call trade on that day. Now, of course, I already owned the TNA, so I was simply rolling over. Let's just assume that you were going to initiate a new trade that day. So you would have bought TNA at 54.27 minus the 142 you got for the option premium. So the cost to buy 100 shares would have been 52.85, and would 52.85 would be the point cost times 100 shares. So the total cost to initiate this covered call trade on that day would have been $5,285. And just keep in mind, when they start trading these mini options, this would cost $528 as opposed to $5,285. So if you were to initiate a new covered call trade on that day, that would have been your cost. And again, that I collected $142 in time premium on that day, and that becomes profit the following Friday. And let's just look at the various scenarios. If TNA increases in price at expiration, I still get to collect that $142 in time value. Now I may lose some money closing out an option if the TNA goes up, say, 2 or 3 points. I'll lose money on the closing out the option, but that's made up because the underlying price of the stock has gone up. So that would cause me to still, even though the stock's gone up and I lost closing out the short option, I'm still going to collect that $142 in time value because that time value decays to zero at expiration. So if the stock goes up, I'm still going to collect that $142 in time value. I may lose closing out on the short option, but that's made up with the increase in the price of the underlying stock. So if TNA remains flat, I still collect that $142 in time value as it expires to zero. And if TNA stock declines in price, I still collect the $142 in time value profit. Now that could be offset by a loss in the stock value, but I'm still going to collect $142 whether the stock goes up or down. And then even if it declines, I can still sell another premium the following Friday and start the process all over again. So either way, if the stock goes up or goes down, I'm still going to collect $142 in time premium profit. So let's take a look at the potential. If I did this every week and collected a similar premium, if you take $142 times 52 weeks, this covered call has the potential to take in $7,384 in time premium. So that's $7,384 in cash that's going to be credited to your brokerage account. And if you divide that by the cost of $5,285, you come up with 139% potential cash-on-cash yearly return, which that's a pretty good cash-on-cash return, regardless of what happens to the price of the underlying stock. So even if the stock declines 20% or even 40%, you still have the potential to realize a good return with this strategy. So a lot can go wrong with this trade, and if I receive 139% cash-on-cash return, a lot can go wrong, and I can still profit. The underlying stock or ETF could decline substantially, and you could still profit. Even if you had bad timing, and when you enter this trade, you could still profit. So there also, you could have volatile price swings in the underlying stock or ETF, and you could still profit. So this weekly covered call strategy gives us a huge advantage over a stock or option directional trade that requires the stock or the ETF to move in the right direction to profit. So in other words, there's a big advantage because the stock can go up or down and you can still make money with these covered calls, whereas with a directional trade, that requires the stock or the ETF to move in the right direction or you're not going to make money. So, and also, a lot of times with these directional trades, when you have volatile markets, you can easily get stopped out. So with the covered call strategy, you have a much higher probability of the trade working out over time and not getting stopped out as you collect this weekly premium. So, and another, as I mentioned before, that 139% cash-on-cash return could be even higher because each week when you receive that option premium, that's cash that goes into your account. So over time, that $7,384 I collect in cash, that allows me to buy more shares of stock and sell more covered calls, which allows me to compound my returns. And I'm going to show you just a couple snapshots of weekly covered calls I sold. And this week, when I took this snapshot, I collected $13,588 in time premium. And this column, this right-hand column on the right side here, lists each trade, and this is the amount of cash for each of these trades that went into my brokerage account. So this particular week, I collected $13,000 in cash. Here's another snapshot, a different week. This week I collected $16,000 in premium, and again, that's all listed in this column here on the right, showing the cash going into my brokerage account. And this week I collected $28,454 after brokerage commissions, and that's listed in this column. So this weekly covered call strategy can be very lucrative because you're receiving these cash premiums every week. And just keep in mind that if I collected $16,000 a week and did that over 52 weeks, it can really add up to over $834,000 in time premium profits over the next year. So doing this each week really allows you to compound your returns. And as I mentioned, I like to roll over the expiring options. I keep the ETF or the stock in my account and simply roll over each Friday to the new option. And here's another example of a option rollover trade that I did. This was for Apple, weekly covered call, and I closed out the February 24th call, and sold to open the March 2nd weekly call. And I used a spread order, and that allows you to save on the bid-ask spread and also on commissions, because it's one commission instead of buying the stock and selling the call, which would be two commissions. You can simply roll over these weekly options with a spread order and just pay one commission. Here's another example. This is for the emerging markets ETF, and closed out the February 24th weekly calls and sold to open the March 2nd weekly calls. Now, here's the reason why these weekly options are so much more lucrative than the monthly options. I took a snapshot. This is of Apple, and it was trading at the time at $585. So the at-the-money call would have been the 585 strike. So what I did is I took a snapshot of the weekly option, and this had 7 days to expiration. So if you were to sell a weekly option that week with 7 days to expiration, you would have gotten 1405 if you just simply sold it on the bid. But if you sold a monthly option that had 36 days to expiration, or 5 weeks, you would have collected 2830. So over the same period of time that you sell this monthly option with 36 days, you could sell 5 of these weeklies at 1405. So with the weeklies, you could collect 70 points of premium versus 2830 points of premium for the monthlies over the same time period. So that's why these weekly options are so lucrative. Here's another example for MasterCard, and in this snapshot, you could have sold the weekly MasterCard at $11.90, or you could have sold 12. You could have sold 12 of these weeklies at $11.90 over the 82-day period for this monthly expiration. So weekly you could sell for $11.90. The monthly that expires 12 weeks later, you'd get $23.50. So that's a pretty big difference. So you're talking about collecting potentially 142 points of premium versus 23 over the same period of time. So again, that's why these weekly options are so lucrative. And as I mentioned, in 2009, in my trading contest account, trading the monthly covered calls, I had a 122% annual return. Here's a snapshot from 2011, and this was my weekly covered call portfolio in 2011. I had an average return of 54.8%. Here's a snapshot from 2012, and I had a 36.9% return in these two accounts. These were two retirement accounts where I was trading weekly calls. So I had a 36% return in 2012. So let's take a look at the investment required to generate $50,000 of yearly income using, let's say, CDs compared to this weekly covered call strategy. So if you wanted to generate $50,000 of yearly income, and you wanted to split your money up evenly between 1-year CDs and 5-year CDs, it would take an investment of $6,756,000 to generate a yearly income of $50,000. So that's a pretty big investment to generate a yearly income of $50,000. But let's assume you did these covered calls, and we saw where in 2009 I had a 122% return. In 2011 I had a 54.8%. And in 2012, 36.9%. So let's just assume you were able to get a 33.3% yearly return from selling these weekly options, which I think is totally reasonable. it would only require $150,000 to generate $50,000 in yearly income. So $150,000 versus $6.7 million. So this, of course, this return is guaranteed, and this return is not. But still, there's not many people that have $6.7 million sitting around to generate an income of $50,000. So I thought this was an interesting comparison to show you the difference between generating income with fixed income CDs versus these weekly covered calls.